Welcome to Living Your Greatness. Each episode, we bring on great people to inspire you to achieve your greatness. We discuss topics all related to health and wellness. Listen to world-class stories, learn valuable lessons, and turn knowledge into action. It is now time for you to unlock your inner greatness. We have a special guest today. Her name is Gwen Preston. For those of you that don't know who Gwen is the resource maven. So Gwen is a mining journalist that has a broad network of contacts in the resource sector. Gwen understands which projects and pieces of news matter. She understands what it takes for a project to advance along the exploration, development, and production path, and what opportunities each stages offer. Gwen knows how the metals market work and alone and within the global economy, and how to profit from precious metals and the resource sector. It's super great to have you on podcast here today. And so first off, if you could just tell us a little bit about yourself. Where did you spend your formative years growing up in Canada? What led you to a career as a resource sector writer? And what motivates you the most in this business?
For sure. Well, first of all, thank you so much for having me on. It's lovely to be here. How did I end up doing what I'm doing? I feel like increasingly these days, career paths can be surprising. Perhaps not as planned out as they were, decades ago when the job options were more limited. So my background is, I grew up in Victoria, and then I went to McGill University and got a bachelor's degree in chemistry. And then I did a master's degree in journalism. And that's, many people say, oh, that's an odd combination. But my idea had been to become a science journalist. I didn't think there was enough journalists out there who had technical backgrounds. And so I just wanted to be able to contribute to accuracy in the journalism world when discussing technical things. But, then I realized the reality of what it is to work in media, terrible job certainty and, writing about break-ins at the 7-Eleven for a decade before you even get a chance to apply to be a science writer. And that didn't appeal so much. But what I saw was a job opening at the Northern Miner, which is a newspaper that's only about global mineral exploration and development and mining. I knew nothing about mining. I didn't know anything about the stock market, actually. I didn't know anything about anything when I started at the Northern Miner, but I could write, I could ask questions, and I had enough of a technical background to start learning about rocks. And so then I spent 5 years as a writer at the Northern Miner, and those were through some pretty interesting times in the macroeconomic world. It was through the global financial crisis I was there, and so I had to try and understand all the impacts that had on metals and miners. Metals and miners had just gone through this major bull cycle powered by growth in China and commodities demand from China. And so sort of how that all evolved and the forces that encouraged major mining companies to make the decisions that they did and how that impacted the whole sector. So it was a great learning platform. I met tons of people. And importantly, when you're a journalist, you can't own stocks. You can't own anything that you write about. You have to be objective. And so I was safe in that I could learn, but I was not actually allowed to put my own money at risk or in play, whichever way you want to look at that. So I learned a lot. And in the middle of my time there, I actually had spent 2 years away as a ghostwriter for someone who was writing a newsletter. So I learned a bit about the newsletter business in that time frame. But then in 2014, I was back at the Northern Miner, and some friends encouraged me to start my own newsletter. And I didn't think I had what it took, but through pushes and prods, in late 2014, I quit my salaried pension benefited job and started my own business in the darkest days of a mining bear market. It was pretty grim out there. And I haven't looked back because I love what I do. And what I do is use that knowledge that I gained about how exploration works, how mining works, who the people are, what you need to know about geology and regions and the processes and the techniques and the financial side of it, to identify stocks that I think have the opportunity to perform well. And I write newsletters about what I'm buying and selling. And the driving concept there is really just that there's a huge opportunity to make money in this sector when the sector is on a run. There's also long periods when it's not on a run, so just ignore it during those periods. But when it's doing well, there's a lot of opportunity there. But it's a sector that requires fairly deep knowledge. And so I try to use my knowledge to convey concisely the things that matter, to help teach a few lessons along the way, and then use my knowledge and network to identify stocks with opportunities so that those who want exposure can sort of leverage my knowledge base to establish their own portfolio. So that's how I got to be where I am.
That's awesome, Gwen. Thanks for kind of giving us that background of who you are. Moving forward to kind of like my next question here, one way to grow our financial wealth is obviously to invest into assets that increase value over time, right? So some examples include investing in stocks, bonds, mutual funds, precious metals, real estate, small businesses, or a combination of all of the above. The objective obviously is to generate cash. So how have you been successful at advancing and growing your own wealth?
It's an interesting question because I am so hyper-focused. So my world is metals and mining. My entire portfolio, my whole portfolio is in metals and mining stocks. I do not recommend that for most people because it is not most people's sole focus to track and be engaged in the metals and mining world. But for me, it is. And so for me, that works. Now, I'm sure that setup is replicated many times. Those who are in particular areas of the tech world or who are in, particular areas of pharmaceuticals. I'm sure there are lots who, like me, have portfolios that are hyper-focused when the opportunity is laid out in front of them and their knowledge base is so applicable to an emerging bull market. Why wouldn't you pile into that? So perhaps that's one starting point, which is that you have to sort of there's a few things. You have to decide how engaged you want to be with managing your money. And then you have to decide sort of related to that, if knowledge bases that you have are useful and can be applied to help you gain advantage. And there's no correct answer to either question. That's really important. You don't have to be really deeply involved in your finances. If you don't like it, if you're not interested, if you want to find a money manager who can do that for you, that's fine. It's just a decision that you have to make. Similarly, but if you want to be deeply involved, that's okay too. And you can be deeply involved in a part of it and let somebody else manage other parts of it. Like there's no one size fits all answer, but you just have to decide how much time and engagement you want to put into your money. And once you come to that answer, then you can develop a plan that makes sense. So I think one of the key things with finances and for younger people when you're starting out in considering investing and it's all very overwhelming. Believe me, like I say, I started at the Northern Miner and I knew absolutely nothing about business, about stocks, let alone about mining. But I've come a long way and I can explain a lot of aspects of how these things work now. And so I'd say it's all very doable. If you're interested, you can learn it. If you're not interested, that's okay. But don't just stick your head in the sand. Find some way of establishing a portfolio that you don't have to manage on a day-to-day or even week-to-week basis. Just find a way of putting a few dollars aside and managing and having somebody else direct those monies for you to some extent. And just be open to the fact that it can be, especially if you find a niche that appeals to you, it can be really interesting. It can be very exciting. It can be very rewarding. When I started at the Northern Miner, I would describe myself as sort of like an anti-mining environmentalist. And where did I end up? I ended up like writing a newsletter about mining stocks because I actually love this space. I love how mining companies are increasingly, obviously they dig up holes in the ground, but the way that they do so, the way that they engage with the environment and the communities and whatnot is evolving in good directions over time. And they produce commodities that we absolutely need. And so I've fallen in love with the space. So I think you just have to be open. You have to decide how much you want to participate and don't just put your head in the sand. There's real ways to get engaged and to learn a lot about how to manage your money and find opportunity.
As a writer, you recommend to your readers what junior miners to invest in. Tell me, how do you know about going along with researching and picking companies to recommend to investors? why should we be confident that you are recommending the right basket of companies to invest in?
So there's a great question. There's sort of two sides to that question. One is, how do I pick the stocks? And the second is sort of like, is the basket the right basket for somebody else? So let me start with the basket side of things. I write about everything that I buy and sell. And so interestingly, because I do that, because I create a newsletter and other people pay attention to what I'm buying and selling, I am partly influenced in my investing, in crafting my portfolio by the need to have options within it that are appropriate for the whole spectrum of investors who follow what I do. So it's what I mean there is I might add some stocks that I don't think are as exciting, that I really like the high risk, high reward end of the spectrum, but I'm going to add some more lower risk, more advanced stage options into my portfolio, partly to service that part of my subscriber crowd. But also it turns out, ironically, to be a great push, because I should have those guys in my portfolio anyways. I shouldn't only play the high risk, high reward stuff, because the high risk means that you often don't get the reward. Whereas the lower risk stuff is more of just a leverage to a fundamental bull market that is evolving. So there's really good reason to hold those lower risk stocks. So I have a lot of stocks in my portfolio and I write about all of them. I caution my subscribers, I make clear that I don't suggest they should also own every stock in my portfolio. I try to also provide some guidance about which parts might work best for you versus, your neighbor versus your cousin. It all depends, again, on how much time you want to commit, what your risk tolerance is, how closely you want to track the stocks in your portfolio. So the basket, and I think we'll get into this a little bit more later, how to craft your portfolio really depends on you. So that's sort of a second side of it. I try to give all the options and you have to pick and choose amongst them the ones that make the most sense for you. As for how to pick the stocks, I mean, we could spend the entire hour talking just about that, but I will do my best to distill it down. Really, it comes down to, I feel a little silly when I say this, but like, is there a good story? And I say I feel silly because that seems too simplistic, right? Tell me a story. But at the end of the day, exploring to discover a new mineral deposit, or to expand a discovery into a deposit of merit, or to turn a deposit of merit into a mine plan that can be financed and built into a mine. These are very complicated, very scientific, very drawn out, very high risk processes. But but they also need funding from investors. That's the only way that exploration works. There's no cash flow until you actually build a mine, which is like the last step in the process. So it all depends on investors putting money into the idea. The only way investors are going to get interested in a story and therefore fund it and therefore enable the story to move forward is if the story makes sense. And so there's different ears listening to that story. Perhaps I would say that my ears are more discerning. I'm going to look a lot deeper into particular technical details because I have that knowledge base. I'm going to have dug right into the backstory of all the people who were involved, because I understand a lot of, where their networks might be involved in and what their past deals actually did. So my ears are perhaps a bit more discerning, but at the end of the day, there has to be a very clear story for what they have, what they think it can be, and how they're going to use investor capital to get from what they have to what they think it can be. And all of that has to be backed by science, and they have to be able to communicate that complex story in a pretty straightforward way. So that's a roundabout way, perhaps, of saying that it all depends on the people, because what I just outlined is a pretty challenging task, incorporating capital markets and geology and all sorts of jurisdictional challenges and all the things that are involved in exploration and mining. Just being able to pull it all together and turn it into a story that makes sense is a big challenge. And so it takes some good people to do that. So it probably starts with the people, but for me to just say it starts with the people is a bit useless, because how do you know? So what I like to convey it instead as, is there a story with science and clear steps and backup plans and a clear idea of how to turn what they have into what they think it can be, which should be more valuable. And there's a lot of detailed science that, you know, the deeper you go into that story, the more factors that you have to understand and consider. But at the end of the day, that's what it comes down to.
So if you were a younger or less experienced investor today, given the times that we are currently in, what percentage of your portfolio would you allocate to precious metal stocks? How would you allocate your metal stocks by percentage based on the following categories? So large producers to small producers versus exploration. And how much allocation would you put into suppliers of the industry, if any? So thinking of mining drillers, mining contractors, equipment suppliers, etc.
Okay, so I think I'll start sort of at the 20,000 foot level, which is, it really depends on what you're trying to accomplish. So in terms of like what allocation should be in precious metals? Well, when I say what are you trying to accomplish, for an individual person, are you managing your entire portfolio? If so, do you have multiple areas of expertise or interest that you're actively researching and understanding? If so, then there's probably multiple arenas that deserve exposure in your portfolio, right? Or it could be that you are a younger investor who, for whatever reason, family ties or where you live, or just, you know, you stumbling upon it in your own research, that you've decided that right now is a particularly good opportunity in metals, which I happen to think it is, but that's almost an aside. And if so, maybe you have a portion of your portfolio that you have decided you would like to manage in this metals market, and maybe another part of your portfolio is, you know, not exposed to this one particular niche area, and that's the only thing that you're trying to understand, right? Or maybe you're a brand new geologist graduate who just got a job with a great capital markets group, and you're getting all kinds of deal flow and interesting opportunities coming at your desk. And then you're more in my situation, where put it all in mining, because these are the deals that are coming to you, and there's probably 10 baggers in that pile. And you just need to put a bit of money into all of them, and you're going to get some really great returns. So it absolutely depends on your context. Now, if I had to try and say like what allocation should be in precious metals, I mean, I'd say that 10% is a pretty good rule of thumb. That said, I don't just write about precious metals. I write about all metals. In the metals space right now, copper and platinum are the two that are most exciting. So like, let's not pretend we're just talking about investing in gold as a safe haven. This is a much bigger pool of fish than that. This is about economic growth. This is about electrification, which is arguably the most important economic force in the world for the next decade. Like all of the infrastructure changes that are required to power a green world. I mean, the amount of copper and graphite and endless list of commodities that's needed for that is really stupendous. Nickel demand is going to double in the next 10 years just based on battery demand, right? So like these things, there's paradigm shifts that are staring down the barrel of the commodity market. And so if you step back, and don't just focus on precious metals, but step back and focus on metals and I say commodities, then you start to talk about oil and gas and things get a little bit more in grain and things. But if you step back and just think about metals, I mean, I would certainly argue for more than 10% exposed to that. But I'm not the right person to ask, because I do not have a lot of, I don't spend time diving into, I don't know what the opportunity is in cryptocurrencies right now, because I don't have time to research that. That's not my world. I also don't know tech stocks or pharmaceuticals. I don't know them. So if you know them, then that impacts your allocation. And so that's sort of I really think there's a great opportunity in metals broadly right now. And so if you want to dive into it, then there's a good chance that it deserves a significant chunk of your portfolio, but it all depends on what else you're considering. Now, within metals, how to choose your style of stock, or how to, as you say, how to disperse your allocation amongst, from the tiny junior explorers who haven't even made a discovery yet, all the way through to, the Barrick or Newmonts of the world who are producing 5 million ounces of gold a year and are the biggest companies in the space, and everything in between. That again comes down to for how much time you want to spend engaging with your portfolio and how much risk you're interested in holding. The discovery end of the spectrum carries a lot of risk. No matter how good a geologic theory might be, based on, you know, what's in the soil, what the rock samples are returning to you, what geophysical surveys, you know, you put like, you can use magnetics and conductivity to get a sense of what the rocks are. No matter how much data you get, the drilling is what's going to tell you if it's actually there, if your idea is actually right. So drilling is very risky. You got to do it or else it's all just ideas. And drill results can make or break a stock. And so those explorers can give you those incredible returns. Absolutely. Inarguably, they can give you very, very incredible returns if it works. Now, the ones that really, really hit it out of the park is that 1 in 100, something like that. It's probably even less if you average over longer periods of time. But in a good metals market, others will do fine and others will completely fail because their idea was wrong and the drills proved them wrong. So the takeaway from that is if you really like the space and you get deeply involved, there's a lot of interesting, engaging, dynamic opportunities at the exploration end of the spectrum for sure. There's a huge amount of risk. There's a whole range of characters. There's a lot of technical knowledge that's really needed to take advantage of this properly. So that's a high risk, high engagement part of the spectrum. But then there's everything else. And so if you believe in metals and mining, there's a huge amount of opportunity that's much less risk if you establish a portfolio that gives you exposure to more advanced projects, deposits that already exist and that mines are being planned around, mines that are maybe being built right now, mines that are being operated, maybe they're going to get expanded, maybe they're going to get bought by another operator. These offer you some splash, which is what I like to call it, where maybe they're exploring to expand the deposit, or maybe they're whatever. There's upside from just advancing the asset itself, and they give you leverage to the price of the metal. And what I mean by that is if gold is trading at $1,700 and your cash cost to produce an ounce of gold is $1,000, you're making $700 an ounce, or your all-in cost. That's great. Now, if gold goes to $2,300 or $2,400, that's a really nice jump. But anyways, your cash cost your cash cost has doubled. The price of gold has not doubled, but your profit has doubled, right? If your costs remain set, then your upside increases way faster than the increases in the price of the metal. That's what leverage is, right? So if Barrick Gold can keep their cash costs pretty stable, right along here, and the price of gold just keeps going up, then every dollar in the price of gold is like $1.50 or $2 or whatever it might be in terms of their profits. That's leverage. And so owning mining companies gives you leverage. So the rule of thumb is that, you know, a miner will often give you threefold the gains in the price of gold, right? So there's a huge amount to discuss there. I've sort of thrown a whole bunch of ideas at you, but how to create a portfolio divided amongst the opportunities in the metals space depends on how much time and risk you want to put in. And don't think that you have to put in the time and risk, because there's great opportunity on the lower risk side of things as well. And you can have a bit of a range there. You can have some more exciting exploration oriented, but still, you know, lower risk assets in there, all the way up to major mining companies who are just giving you straight leveraged exposure to a rising metal market.
Yesterday, the US Federal Bank concluded its latest FOMC review. What were some of the key takeaways from that meeting? And more importantly, how might the precious metals be affected as a result from the meeting?
Yeah, so the FOMC obviously sets interest rates, right? This is Chairman Powell determining interest rates. And I mean, it used to be that they just talked about interest rates, but now they also basically run all of the support that the market is getting, ostensibly to recover from COVID. I mean, to recover from COVID. I shouldn't say ostensibly, to recover from COVID. So all of the bond buying that's happening, corporate and government bond buying that's happening, and zero interest rates. These are all machinations of the Federal Reserve. I mean, there was nothing dramatic in the minutes from yesterday. They basically, kept the line exactly where it is in the sand, which is that interest rates are still zero. Inflation, like the numbers are looking a bit better. Growth is looking better. Inflation is starting to show up, but nothing is anywhere close to recovered enough for the Fed to consider stepping back its supports at this point. And stepping back its supports would mean not putting as much money into the bond market and or raising interest rates. Now, so that's good in a couple ways. First of all, the most important driver for the price of gold is real interest rates. So that's what the interest rate is minus inflation. Usually you look at sort of like a 10-year yield minus inflation as a proxy for the real interest rate that is considered in the gold space. And if real interest rates are negative, that means it doesn't pay to own bonds, right? It's actually going to cost you to own bonds. Like they're not going to yield for you. You might get price on bonds, like the price of the bond might go up, but you shouldn't own a bond for yield because inflation is going to take your yield and then some. You're actually going to be paying to loan the government money. So negative real rates encourage investors to not own bonds and stocks, or not own bonds, but instead to own stocks and gold. And gold, it's not that gold yields. Gold also does not pay you to hold it. But the types of macroeconomic environments that lead to negative real interest rates support gold price gains. So you own gold when yields are negative because gold not only isn't taking your money, but is likely to increase in price. Okay, sorry, that was a bit complicated, but that's the argument to own gold powered by negative real interest rates. We are very, very clearly in a negative real interest rate environment right now. We were headed that way when COVID hit, and then bam, we got like slammed to the ground and like below ground, and interest rates are very negative. There is a little bit, and that is here to stay for quite a while. The Fed 8 months ago made a splash saying not only are they going to let inflation hit 2%, which has always been their sort of thing, they're going to let it run hot so that it averages 2%. And because it's been way below 2% for ages, it would have to be well above 2% for quite a while before you average 2%. And that was their way of saying, look, nobody stress that we're going to raise rates. We are going to keep interest rates at the very, very bottom so that everybody can get access to as much debt as they need to support this economy to get back on its feet. Stop stressing about interest rates. Interest rates are not going up anytime soon. So that creates fundamental support for gold. Absolutely. Even though that is the case, gold hasn't exactly just shot straight up to the moon, but that's the nature of a bull market. Bull markets never just go straight up. They're 2 steps forward, 1 step back, and especially in gold, which is a complicated beast that gets impacted by everything from geopolitics to, the moves in the bond market to currency exchanges and all of these things. Like it's complicated when you dive in, but the support is very much there for the gold market. The hilarious thing is I forgot where we even started this question. Oh, right, the Federal Reserve. Gotcha. Okay, I'm back. And the other thing I was going to say is let's remember that there's a huge number of unemployed Americans still related to COVID. And while, inflation numbers are rising, part of that is base effect. You go back 1 year from now, where were we? We were in the trenches, man. We were in the bad part of COVID. New York hospitals were just strained to the max. It was really bad. So that's what's called a base effect. The year over year effects look really strong because a year ago things were so terrible. Anyway, at the end of the day, the economy needs to improve a lot more before the Federal Reserve is going to increase interest rates. They also have been very clear that they will telegraph well in ahead before they take away any of the other supports that they're giving to the market right now. And they have not telegraphed that at this point. So that means that the stock market will continue to run, likely, but that also means that gold can run right alongside it because the negative real rate setup is there so clearly. Some people say that gold needs the stock market to crash for it to work. I don't agree with that. I think gold, and think there's lots of evidence that gold can do just fine alongside a stock market, as long as there's some risk in the stock market, which I think is fairly clear that there's some risk in the stock market. For a whole number of reasons. And so as long as there's some risk in the stock market and as long as real interest rates are negative. So the Federal Reserve didn't do much yesterday, but their broad stance is very supportive of gold, and their support of inflation is supportive for metals as a whole, because as a US dollar weakens in an inflationary environment, metals always do well.
What factors or other fundamentals do you see impacting the precious metals prices moving forward?
I can maybe break that down into the different precious metals. So there's gold, there's silver, and then there's the platinum group elements. For gold, I think we're just coming out of what had been a bit of a holding pattern. So gold ran phenomenally well from sort of May through August of last year of 2020. Gold just kicked butt. It did so well. And the thing with that is whenever a price really moves up, there's almost always going to be a step back, a consolidation, because that's just the nature of price moves. And also it probably got a bit ahead of itself. And then we also got into this strange setup where everybody expected inflation to show up, but then nobody knew exactly how or when it was going to show up. And inflation really matters in the gold logic because it determines how negative those real rates are. The more inflation, the more negative real rates are, because rates are at zero. So inflation is what's pulling them down. Inflation is what you take away from interest rates to get real rates. And the confusion over when inflation will show up and how strongly it will show up and sort of how we should deal with that inevitability, but ambiguous inevitability, really put a pause on gold for a while there. And so instead of paying attention to real rates, which were very difficult to calculate because it's only a two-part equation and we didn't know one of the parts, the inflation part, people instead started paying attention to nominal yields. So like, what does the 10-year treasury just pay you? And that yield kept marching up and up and up and up and up and up and up. And there's lots of reasons for that. Yields rise when prices fall in the bond market. Prices were falling because same thing, people expected inflation to show up. Bond traders expected inflation to show up. So they didn't want to buy bonds now. They wanted to buy bonds later when yields were higher. So because the focus sort of shifted to these nominal yields instead of paying attention to real yields, gold got hurt by that. We're coming out of that now. I think the 10-year yield has completed its march up and has stabilized and is coming down again. And I think inflation numbers are starting to show up. So I think that hiccup in the market is starting to be in our past a little bit. It's still present, but it's not as bad as it was a month or two ago. And so that will certainly help in the gold space. The gold space also undergoes a lot of seasonality. So it just regularly is strong in January and February, and then it's regularly strong in August, September, and October. So that will probably come into play as well. Then there's a physical side to the equation. Physical buying is very strong in India, and Indians are, to be blunt, probably not very focused on buying gold right now because the COVID rates in India are terrible and scary. And so there's a bunch of factors right now that have gold just sort of middling. It's just existing. I say that, but it's existing at a very good level. We are like $17.70, $17.60 per ounce. That's a great price. And gold miners can make a whack of money at that price, which is important. So I think gold is going to do fine for the next little while. I don't expect it to be particularly exciting. It might break up or it might just be fine. I expect sometime between now and September for it to break up through 1800. I don't know when, but I think I'm just not sort of worrying about the day to day. The silver side of the equation is a little bit different. Silver can just track gold as a precious metal, but silver is also very much an industrial commodity. And in today's day and age, it's important that it's not just an industrial commodity, but an electrification metal, right? It's a green energy metal. And so the silver demand supply balance is pretty bullish. There's a lot of people out there who believe, and I tend to agree, that silver will outperform gold in this bull market. So over the next few years, silver will outperform gold because the industrial demand side is really going to influence it to the upside. And similarly with the platinum group metals. Now, I'm not going to get into the balance between platinum and palladium and how catalytic converters went from one to the other, and now they're going back again, and what that did to the various prices. But at the end of the day, emissions regulations keep getting more stringent, especially in the largest car markets in the world, so in China in particular. That means that you need more platinum or palladium, whichever one you're going to use, or rhodium in your catalytic converter. And that demand side is inarguable. Now, how it waxes and wanes between the two is a little bit up for debate, but there isn't a lot of supply flexibility in that market. Really, palladium has been in a deficit for 8 years. And so I'm pretty optimistic on the PGE side of things as well, on a more, basically on a similar line to my silver rationale, which is that, you know, the need for these metals in the electrifying world is very apparent, and the supply is just not really there.
Focusing on silver, is there such a thing as a silver squeeze? What is it exactly? And do you think the retail market can have an impact on the silver price?
Interesting question. So I'm not an expert on this. There's others who spend a lot more time understanding these nuances, but from a stepping back perspective, I mean, a silver squeezing a stop is like the GameStop thing, right? Where what happened there is that there were people who were short GameStop, who were betting that that stock was going to decline, and the Reddit community realized that that was happening, and they started buying, and they pushed the price up. And when you're short a stock, you can lose an endless amount of money. When you're long a stock, when you own it, you can only lose the amount that you put in. When you're short a stock, you can lose however much the price goes up, and the sky's the limit there, right? So if you can push a stock up and someone has a short position on that stock, you will force them to sell at some point, because they won't just keep they'll just see their loss number climbing, and at some point they will sell. So that's what happened to GameStop. Now, doing it to GameStop is a pretty clear setup, because it is a stock, and you can be long the stock or you can be short the stock. Doing it to silver is much more complicated, because you're not the moves that you would make to try and influence the silver market are not very much about buying physical silver, about going to a store or online for ordering a physical bar of silver or a coin. It's more about the papers market, and and that market is very deep. Like it just really deep. Now, the depth of that market, by which I mean the fact that there is there's orders of magnitude more silver exposure available through paper than there is actual silver. That discrepancy is what spawns all of the conspiracy theories in the silver market, like about whether the paper market is all a hoax and whether the silver price is manipulated through the paper market. Putting those questions to the side, it's the fact that the paper market is so massive makes it hard to short that stock or that commodity. There's also the fact that in the GameStop example, there were a few hedge funds who decided the stock was going to go down, and they got shorted. That's what happened. In the silver, or in any metal, in any commodity, the reason that a futures market exists, that paper market exists, is because traders and people who make the metal and people who trade the metal need to hedge their bets. They actually have to have exposure long and short on the price spectrum so that they can manage risk, because the price is going to move and they can't just be exposed to the silver price or the grain price or the fertilizer price, because these prices can be quite volatile. They have to hedge, so they have to have long positions and short positions so that they can reduce their risk exposure to those price fluctuations. Because a lot of the players in the market therefore are exposed across the spectrum, it's pretty tough to squeeze them, because you're pushing them one way, but they've got all the room they want because they're also protected the other way, right? So it's a much more complicated setup. I know that there's people out there who do believe that you can squeeze the silver market. And the honest truth is I haven't delved into those arguments enough to know for sure. So I'm not trying to give a definitive answer. I'm just sort of painting the picture that it's a much bigger and deeper and more complex environment than trying to squeeze something like GameStop.
Recently, there have been a few mergers or takeovers, such as Newmont and GT Gold. Do you anticipate any other acquisitions this year? Any leads?
So the M&A, mergers and acquisitions side of the mining space is always a topic of much discussion, and fair enough, because that's the structure of, that's the business model, right? Explorers explore, they find a deposit. The team that makes a discovery is not likely a good team to then plan a mine, let alone build a mine. Heaven forbid, run a mine, right? They're different skill sets. And so the business plan in the metals space is that, a discovery oriented team takes on the risk, raises the capital, makes the discovery, delineates the deposit. And then at some point along there, maybe another team moves in to turn it from a new deposit into, a basic mine plan. And then maybe they start to build it, or maybe another company moves in and buys it to build and run the mine, because that's different companies fit different stages of the process. And because that's the way that the business works, there's endless conversation about who might buy what and which projects are have the light shone on them as potential takeouts. And fair enough. Now, will this trend continue? I think the two factors to consider are, in the last metals bull market, so I'm talking sort of 2006 through the financial crisis, which was down and back up again for metals, through to 2012, producers went a little crazy. So they started focusing on making more metal. Doesn't matter whether we're making more money, we're just going to make more metal. Turns out, if you didn't catch it from my statement there, that didn't work out very well for them. Shareholders got left in the dust. Their debts went crazy. They overpaid for acquisitions. It was actually atrocious what they did. So even though gold hit $1,900, gold miners were desperately in debt and not making money for their shareholders because they kept just wanting to make more ounces. Well, it doesn't matter how many freaking ounces you make if you're not making money on any given ounce. So that mindset got turned 180 degrees in the bear market. Okay. So mining companies, the big miners of the world, turfed their entire management teams. They brought in completely new teams. They got rid of all those overpriced assets. They wrote down billions and billions of dollars in failed deals. They streamlined their acquisitions and they focused on making money. That's great, because mining companies are now awash in cash. I can barely underline this enough. If you look in the broad stock market, companies are generally speaking awash in debt and have dividends, if they pay dividends, that are between 1 and 1.5%. Gold miners are in net cash positions and are paying out 3% dividends. And those dividends are set to rise because their cash flows just look better and better as the longer you make the chart. That matters because I think that's going to attract generalist investors over to the gold mining space, because the economics are just very apparent. They're just really financially robust. It also means that that they have cash and they have share price strength, mining companies do, to make those acquisitions. Now, I do not think that they will be as aggressive on the acquisition front as they were in the last market. And I don't want them to be, because remember when I said that was a terrible idea? I don't want them to do that again, but they will make acquisitions for sure. So the majors will make some acquisitions to just keep their production profile where it is. And there'll be acquisitions that make sense. So in jurisdictions where they already operate, or, an asset, a deposit that can feed maybe into a mill that they already have, or something where there's synergies, where there's experience that makes the fit sensible. Where we'll probably see a little bit more growth is in the mid tiers. So the big majors are the huge mining companies, and they're not going to do growth for growth's sake. They did that last time and it was a bad idea. The mid tiers, who, as the name suggests, are a little bit smaller, they're the ones who are more motivated to try to become a major during this market. And so they're the ones who are going to do a little bit more on the wheeling and dealing side. And just this week, I think on Monday, we saw an interesting move where Fortuna Silver made a bid to buy Rox Gold. And it's a bit of an interesting bid because Fortuna Silver is sort of a Latin America, South and Central America focused company. Roxgold has 2 mines in Burkina Faso and 1 development project in Cote d'Ivoire. So there didn't seem to be a lot of jurisdictional overlap. There didn't seem to be a lot of mining type overlap. But the companies are arguing that it makes sense because it's going to create an upper mid-tier producer with a good growth pipeline because of these assets that Roxgold can build that could propel them higher in the ranks. So we'll see how that works. I don't really have an opinion on that merger right now, but it's the mid-tiers who I think are going to be doing more of the interesting M&A type action. The majors will also make some deals, but they'll be much more selective than they were in the last market. As for what's going to get bought, I mean, again, it sort of comes down to my first answer. Does the story make sense? So when you're talking about buying an asset, now you're talking about something that's like on the developed end of the spectrum. The deposit is clearly there. There's been economic studies, the metallurgy. So how you pull the metal out of the rock is understood. There's like an engineered flow sheet for what the process plant would look like. The permitting is probably, on its way. And so there's some confidence that you'll actually be allowed to build the mine. So it's way down the spectrum. And just all of those things that I just listed need to have check marks beside them. The asset needs to make sense. They're not going to spend a bunch of money, to buy something where there's a lot of question marks about whether you'll be able to build it or whether the process plant is going to be able to pull the metal from the rock. You really need to just diligently answer all the questions. And if you can do that, then you're putting your asset into contention for getting bought.
So Gwen, as you are doing your own due diligence on making your next investment pick, what is the single most important factor that gives you the aha moment where you then know this is the one?
The plan. How are you going to take what you think it is? And what are you going to do to what you have to turn it into what you think it can be? And within that, is there a big value gap between what you have and what you think it can be if that test works out? So if there's a big value gap and you have a clear plan, there's no guarantees that it will work because rocks are rocks and they will give you the answers that they decide to give you. But if there's a clear plan and there's funding for that plan and there's technical competence, then I'm encouraged to have exposure to the possibility that it works, right? Because if it works and you go from pre-discovery through to discovery or, initial discovery through to, oh my gosh, it's way bigger than we thought. That's the kind of value gain that gets mining investors excited. So I need a clear plan for getting from A to B and for there to be a big value difference between A and B so that if it works, I'm going to make a bunch of money.
What advice would you give millennials like myself about getting more familiar with this sector? What should they read or listen to? And who are some of the mining people that we all should be following?
Yeah, good question. I guess it depends really on how deeply you want to get involved. It sort of goes back to what I was saying earlier about how many different things are you trying to learn about? How deeply do you want to dive into this space? I think the exploration side of things is a very tough game. And for example, I say it's all about the story. Well, there's a lot of people out there who can sort of sell a good story that isn't actually that good, right? And so that's where that technical knowledge and knowing people's backstories and things like that sort of comes into play. So if you want exposure to the high risk, high reward end of the discovery end of the spectrum, my main thing there would be don't try and do it by yourself if you don't have that technical and industry knowledge. You need either a group of friends, maybe it's online or maybe it's in person who you're doing it with, so you can all sort of do parts of the research and then help each other with it. Or maybe, I'm a little bit biased in this sense, but I write a newsletter specifically to share my knowledge on these things with my subscribers. In the newsletter world, I would say before you sign up to any newsletter, check and see what their funding model is. So if a newsletter writer takes money from companies to do write-ups, then they're going to write positively about that company. That's just the nature of that business model, right? If, however, a newsletter writer does not take money from companies, then the newsletter writer is beholden to his or her subscribers instead. And so that is the business model that I follow. And I think that's the business model that creates more objective and therefore useful advice on exploration stocks. So I really think that at the end of the day, don't try and do it alone, because there's too many ways that you can get tripped up. And there's so many factors to try and consider, from like how to manage risk and seasonality and all the different things that can push junior company share prices around. It's pretty complicated. So don't try and do it alone. I say try and find some allies in the fight to help you with the due diligence and with the understanding what to do when stocks make moves, and make sure that they are true allies.
What sectors do you think will perform best in 2021?
I'm obviously going to limit my answer to the mining space, because I have been clear that I don't know much outside of mining. Copper is going to keep doing really well. I think uranium might. We've been sort of waiting for a uranium bull market for a few years now, but the pieces keep lining up. Like they keep looking more and more like it might really go. And when uranium markets go, they go absolutely wild. So uranium is sort of a maybe, but I think the reliable ones are copper and gold. Sorry, they're a bit boring because they're sort of the two biggest spaces for those who focus on metals and mining. But I really do think that those are good spaces to be exposed to.
What are your top stock pick recommendations for 2021?
Oh, okay. So I'll do them sort of across the spectrum a little bit in terms of risk profile. So down at the discovery end of things, I'll name Heliostar. HSTR is the ticker symbol on the Toronto Venture Exchange, Heliostar. This is a company that has a really interesting project in Alaska called Unga that has 4 different target areas that all have great odds of success. There's a big backstory here about how they sort of just got this asset through a merger, and 3 of the 4 target areas got very little exploration in the last decade. But the new technical team that's part of this merged entity is fantastic. So I really think Heliostar has a good chance. They also have some assets down in Mexico that look really interesting. So there's a lot of kicks at the can for success with Heliostar and a very strong technical team. So I really like Heliostar. If we're stepping up the development ladder here, I might next go to, maybe I'll just name 2. So just to keep it simple. So then I'm going to go all the way to Telson Mining. So Telson is an interesting story. They have an operating zinc, lead, silver mine called Campo Morado in Mexico. They have a half-built gold project called Tahueto. The market had written them off because they were deeply in debt, and like literally the market had written the stock off, but a new group has gotten involved. They're in the midst of renegotiating all of their debt. There's a whole bunch of money that just got brought in to finish building the gold project. The new group that got involved is really helping improve the productivity at the operating mine. And I think that Telson is going to be a real turnaround story this year. So TSN is its Toronto symbol. I don't remember its US ticker symbol, but TSN in Toronto. So those are the 2 that I'll name.
What is the best place for our listeners to find you?
For sure. So my website is resourcemaven.ca. That's ca, not com. So resourcemaven.ca. My contact information is very clearly there. And if you're interested in what I write, there's the opportunity to sign up for a free trial of any of my newsletters there. I have a variety, depending on what's part of that risk profile you like to play in. So I have a sort of higher risk newsletter. I have a lower risk newsletter, and then my partner writes a silver newsletter as well, if you're particularly interested in silver. So resourcemaven.ca.
Thank you, Gwen. Thank you so much for your time today. It was a pleasure to have you on the show, and I hope to connect with you again in the future and have you back on the show.
Thanks so much.
This podcast is for informational purposes only and is not to be considered personal, legal, or investment advice or a recommendation to buy or sell securities or any other product. It is based on opinions, current events, press releases, and interviews, but is not infallible. It may contain errors, and Living Your Greatness offers no inferred or explicit warranty as to the accuracy of the information presented. If personal advice is needed, consult a qualified legal, tax, or investment professional. Do not base any investment decision on the information contained on Living Your Greatness or our videos.